Welcome to video 1 of part 3 of the EA Tax Training free EA exam preparation course for 2026. My name is Tom Norton. I am both a certified public accountant and an enrolled agent, and I will be your guide and instructor throughout this course. Part 3 of the EA exam is all about representation, practices, and procedures. Basically, it covers how enrolled agents should interact with their clients and with the IRS, and the penalties for failing to act in a professional, ethical manner. I would like to remind you that you can get a free copy of the slides for all the videos in this course. On YouTube, in the description below each video, is a link where you can have a PDF of the slides emailed to you. You may have to click on the word more to see the full description. As I go through the slides, I will talk about the most important issues and the ones that might need a little bit extra explaining. But just because I don't mention something that's on the slide does not mean that it's not important or that you should ignore it. Watch the videos and study the slides, whether I specifically mention something about it or not. With that out of the way, let's look at what we have in store in part 3. We have 4 videos for you in part 3. This first video you're watching now is about practices and procedures. Video 2 is about representation before the IRS. Then in video 3, we'll talk about specific areas of representation. And finally, in video 4, we'll talk about the tax filing process. As always, I look forward to guiding you through all of these topics. One important point about the 2026 exam and this course. The 2026 EA exam, officially known as the Special Enrollment Examination, is based on the 2025 tax law, rules, and regulations. Specifically, it is based on the law and rules as of December 31st, 2025. So that is what we will be dealing with in this course. The good news is that big 2025 tax law, the One Big Beautiful Bill Act, or OBBBA, did not have any significant effect on Part 3 of the EA exam. So this course is relevant for all exams given between May 1st, 2026 and February 28th, 2027. So without further ado, let's jump right into video 1, practices and procedures. Specifically, what we will cover in this video is practice before the IRS and what that means, becoming an enrolled agent, practitioner duties and restrictions, sanctionable acts, and then rules and penalties. Our free resources from irs.gov, and in this case, these are not just suggested, but in my opinion, they are mandatory. You must get these 2 publications. First is Circular 230, Regulations Governing Practice Before the Internal Revenue Service, and then Publication 947, Practice Before the IRS and Power of Attorney. These 2 publications cover most of what you need to pass Part 3 of the exam, not just this video, but all of Part 3. I have put the most salient points of these publications on the slides, of course, but still, even with that, you will definitely want to get these, read these, and study these publications. Speaking of, this is what the front page of Circular 230 looks like. It looks a little different than our other IRS publications that we've seen. So first of all, we can see that it's called Treasury Department Circular number 230. Of course, the IRS is part of the Treasury Department, but this one is specifically labeled that way. You'll also see that the last revision was June of 2014, so it's been about 12 years since this was revised. Now, the IRS is in the process of updating this document. They released a year or more ago a draft of an updated version. They put it out for public comments. They have not, though, released the final version yet. I have no idea when they're going to do that. It's very possible they will release it in 2026. But remember what we just said, the 2026 exam is based on the rules as of December 31st, 2025. So for the 2026 EA exam, this is the version that we will be dealing with, even if they bring out a new version in 2026. So now let's talk about practice before the IRS and exactly what that entails. This definition of practice before the IRS is very important. You will certainly get a question or two about it on the exam. So, practice before the IRS includes all matters relating in any way to any of the following: communicating with the IRS on behalf of taxpayers, representing taxpayers at conferences, hearings, meetings, etc., preparing, filing, or submitting documents, or advising on the preparation, filing, or submission of documents with the IRS, and providing a client with written tax advice on one or more federal tax matters. So when you think about practice before the IRS, what does it mean? It means communicating, representing, preparing, and then giving written tax advice. So who can practice before the IRS? Well, the following individuals have full practice rights before the Internal Revenue Service and are subject to Circular 230. First of all, attorneys, then certified public accountants, and finally, enrolled agents. You are studying, presumably, to become an enrolled agent. Once you are one, you will have exactly the same practice rights before the IRS as attorneys and certified public accountants. And that's a really good deal because think about it. Become an attorney, usually you have to have a bachelor's degree first, then you have 3 years of law school, then you have to take the bar exam, and then you are licensed by your state. To be a certified public accountant, you have to have at least a bachelor's degree and then either a master's degree or a number of hours equivalent to a master's degree. Then you have to pass a very rigorous exam. Then you have to get experience working for another CPA for a year or more until finally you are licensed as a CPA. To become an enrolled agent, you need to pass the 3-part EA exam and go through a background check. We'll talk about exactly the process here in a few minutes. But besides that, there are no other requirements. So you don't have to have, for instance, a college degree. You don't even have to have a high school diploma. You don't have to have any particular amount of experience. So attorneys and CPAs are licensed by the individual states. The enrolled agent credential is given by the IRS themselves. So the IRS is confident enough in the exam that they give and the background check that they do to allow you those same practice rights that attorneys and CPAs have. So it really is a great deal, and congratulations to you on becoming an enrolled agent. There are some individuals who have what are called limited practice rights before the IRS, and they still are subject to Circular 230. So, among those are annual filing season program preparers, or AFSP preparers. So, this is a program that allows people without any other credential who demonstrate tax knowledge by taking a certain number of continuing education hours each year, including a 6-hour annual federal tax refresher course and annual exam to limited representation rights before the IRS. They must have a PTIN, or a preparer tax ID number, and of course they are regulated by Circular 230. Now this allows them to represent taxpayers only with frontline IRS personnel, so customer service agents, revenue agents, etc. If it goes beyond that, if it has to go to a supervisor, for example, then the AFSP preparer would have to step aside, and then an attorney, a CPA, or an enrolled agent would need to take over at that point. It's also important to note that the AFSP preparer has to be an AFSP preparer both in the year that they prepared and signed the tax return and in the year that they are representing the taxpayer. So, for example, if we're talking about an audit, those usually happen a couple of years after the return was filed. So they would have had to have the AFSP credential both when they sign the return and when they are representing the taxpayer. It is important to note, and you want to know this for the exam, there is no fee to become an AFSP. And then also, Passing part 1 of the EA exam within the last 3 years allows you to skip the annual refresher course. So remember, we said there's this 6-hour annual federal tax refresher course and exam. If you have passed part 1 of the EA exam in the last 3 years, then you don't have to worry about that. Of course, you still have other continuing education requirements, just not that annual 6-hour course and exam. So if you are on the road to becoming an enrolled agent and you've passed part 1, but you haven't passed the other parts, then you may want to go ahead and apply for this AFSP designation. Or if you're just maybe not interested in becoming a full-fledged enrolled agent, then you might be interested in becoming an AFSP preparer. Next, let's talk about unenrolled tax preparers. So those are ones without the AFSP, without being an enrolled agent, etc. They have virtually no representation rights before the IRS. So in order to prepare tax returns for compensation, you do not have to have any kind of credential. You don't have to have an AFSP or an enrolled agent or anything else. Anyone out there who gets a PTIN, a Preparer Tax Identification Number, can prepare tax returns for compensation, but they will not have any representation rights before the Internal Revenue Service. There are a few other people who also have limited practice rights before the IRS and are subject to Circular 230. First of all, appraisers. They're not really representing taxpayers, but they can appear as a witness. So, for example, let's say a taxpayer donates to a charity a piece of art, some artwork, and then they go to an appraiser. They get that appraised to establish the value and the deduction for their charitable contribution. That appraiser can act as an expert witness in front of the IRS. And then enrolled retirement plan agents and enrolled actuaries can represent taxpayers, but only in their areas of expertise. And then low income taxpayer clinic student interns who are supervised by a practitioner can request authorization from the IRS to represent a taxpayer before the IRS. So sometimes colleges and law schools will put on income tax clinics where they help low-income individuals prepare their tax returns. So the law students, the accounting students will sometimes work at those clinics. They will help taxpayers prepare those returns, and they can request from the IRS to represent taxpayers on a limited basis, and sometimes the IRS will allow that. There are some people who do not need any credentials whatsoever to represent a taxpayer before the IRS, and that is because they have a special relationship with the taxpayer. So first of all, an individual can always represent themselves. You do not have to have an enrolled agent or CPA or an attorney to represent you. You can represent yourself. Similarly, an immediate family member can represent you. So it's limited to a spouse, a child, a parent, a brother, or a sister. But any of those people can represent you before the IRS. They don't have to have any credentials. An officer of a corporation, association, or organized group can represent that entity. A general partner can represent the partnership. A full-time employee can represent his or her employer. So this is a pretty broad category. Any full-time employee can represent their employer before the IRS. And then a fiduciary, so like a trustee, an executor, a personal representative, etc. They're not so much representing the taxpayer as standing in the position of the taxpayer, and therefore they can represent that entity before the IRS. So who cannot practice before the IRS? Well, essentially, it's anyone that we haven't already listed as being able to be eligible to practice. Also, corporations, partnerships, or other entities other than an individual are not eligible. So it has to be an individual. It cannot be that the taxpayer appoints the ABC law firm to represent them or the XYZ tax firm to represent them. It has to be individual members of that firm that are appointed. And in our next video, we'll show you exactly how you go about appointing a representative to represent you. before the IRS. And then anyone who is currently disqualified by the IRS cannot practice before the IRS. And we are going to go into detail in this video about how a person might become disqualified to practice before the IRS. PTIN requirements. So the IRS requires anyone who prepares tax returns for compensation to have a preparer tax identification number. So what does that mean to be a tax preparer who is required to have a PTIN? Well, the IRS defines a tax preparer as anyone who participates in the preparation of all or a substantial portion of a tax return for compensation. It doesn't matter if they are full-time, part-time, or casual preparers. It does not matter, by the way, if they are the one signing the return. So the one who signs the return is the person who is primarily responsible for the overall accuracy of the tax return. But in a firm, for example, there might be several people who work on that tax return. So you may have a junior staff person who does the initial work and preparation of the return, and then a more senior staff person who reviews the work of the junior staff person. And then you might have both a manager and a partner who will review it, or maybe it's just one of those, either a manager or a partner. So let's say a manager reviews it and they sign the return. You have to have the PTIN of that junior tax person, the senior tax person, and the manager all associated with that tax return, even though the manager is the only one who is actually signing the return. Individuals, though, who perform only clerical duties or mechanical or administrative duties do not need a PTIN. So this would include people who are just doing data entry into the tax software, where they're not actually thinking about what's right and what's wrong and what do I do with this information. They are just mechanically inputting the data into the software, for instance. They do not need a PTIN. You will want to know that distinction. You're likely to get a question about that. So all paid tax return preparers have to have their own PTIN, but volunteers do not. Again, you want to know that distinction. It is for paid preparers. So the IRS has something called VITA, which is the Volunteer Income Tax Assistance Program. That's something, by the way, that you might be interested in. You can work at a VITA tax clinic for low-income taxpayers. But those volunteers, because they're not being compensated, do not need to have a PTIN. How do you get a PTIN? Well, it's actually very easy. You can register for it online with the IRS. You go to irs.gov/tax-professionals, and you can see there how to get a PTIN. You have to be at least 18 years old. You will undergo a limited tax compliance check to make sure that you are current on all of your tax returns. You do have to pay a fee. It's just under $20, I think, this year. And then you have to renew it every year. So if you want to keep being a tax preparer, then every year you're going to pay this small fee and renew your PTIN. So now let's talk about becoming an enrolled agent, which is what you are here to do. So not only for your own knowledge, but for the exam, you will want to know all of the steps and exactly how you become an enrolled agent. First of all, the requirements. There are two paths to becoming an enrolled agent. The first one is by examination, and that, of course, is probably why you are here, as you are going to take the EA exam. So the first thing you have to do is you have to get a PTIN. So you go over there to irs.gov/tax-professionals, you get a PTIN. Also on that webpage, you'll see an actual path to figuring out how do you become an enrolled agent. And it will show you all of these steps and how you sign up to take the exam, et cetera, and so forth. But first you get that PTIN, then you apply for and pass all three parts of the EA exam, or the special enrollment examination. And then you file a Form 23, which is your application to be an EA. Again, you can do that online. So you have to wait till you pass all three parts, and then you fill out that Form 23 online. Then you will have to pass a background check and a tax compliance check that is conducted by the IRS. So you cannot have engaged in any activity which would result in suspension or disbarment under Circular 230, which we'll be talking about in this video. But if you've ever engaged in any activity that would have gotten you disbarred, then they are not going to allow you to become an enrolled agent. Also, they're going to make sure that you are up to date on filing your returns, both individual and any business returns you're associated with, along with paying any of your taxes. Now, if you are on a payment program, that's okay, as long as you are current on your payments from that payment program, but they are going to make sure that you are up to date. The second path to becoming an enrolled agent is for certain previous IRS employees. So this is an employee of the IRS or a former employee of the IRS. They had to have had at least 5 years experience in a position that involved interpreting and applying the Internal Revenue Code and regulations. So if you ever worked for the IRS will determine whether or not your position meets these requirements. If it does, then there is no exam required. You don't have to take the EA exam, but you must apply for your EA within 3 years of leaving that position. So again, even if you're not personally interested in this because you never worked for the IRS, you want to know this for the exam. So you'll want to remember, had to have at least 5 years of experience. It had to be in a position that involved interpreting and applying the Internal Revenue Code. And you have to apply within 3 years of leaving that position. Then you fill out the Form 23, you pass the background check, and then that person can become an enrolled agent without taking the exam. Enrollment renewal. So all enrolled agents must renew their enrollment every 3 years. And you do this again online with this 8554. It is easy to do. And your year of enrollment depends on the last digit of your Social Security number. So it's not just that you get your EA in 2026 and then in 2029, 3 years later, you renew. That's not the way it works. Your renewal, you may have to renew the same year you get your enrolled agent credential. It depends on the last digit of your Social Security number. So if your Social Security number ends in 7, 8, or 9, or if you don't have a Social Security number, and by the way, you do not have to be a resident or citizen of the United States to become an enrolled agent. So that's why there can be people with no Social Security number who are enrolled agents. So they would fit into this category. So for those people, end in 7, 8, or 9, or do not have a Social Security number, you must renew your enrollment between November 1st, 2026 and January 31st of 2027. If your Social Security number ends in 0, 1, 2, or 3, then you will enroll between November 1st of 2027 and January 31st of 2028. And then if it ends in 4, 5, or 6, you are between November 1st of 2028 and January 31st of 2029. And then this is a rolling system. So the people who end in 7, 8, or 9 or no Social Security number, they will have to enroll again between November 1st of 2029 and January 31st of 2030, and then so on and so forth. Once you become an enrolled agent, your education is not over. During each 3-year renewal cycle, you have to have at least 72 hours of qualifying continuing education. In each calendar year, you have to have at least 16 hours, including at least 2 hours of ethics. So when we talk about over 3 years having 72 hours, obviously that is an average of 24 hours per year. But you don't necessarily have to have 24 hours in each of those 3 years. But you do have to have at least 16 hours in any one year and at least 2 hours of ethics in any one year. So at the end of the 3 years, you have to have at least 72 hours. And of those 72 hours, at least 6 hours have to be in ethics. So you could have, at the end of 3 years, 66 hours of other courses and 6 hours of ethics, and that would qualify you for 72 hours. But the point is, the ethics hours are included in the 72 hours. It's not a separate requirement. And in any individual year, you have to have at least a total of 16 hours, and 2 hours of those have to be in ethics. For new enrolled agents, the month of enrollment begins the cycle. So during that first cycle, you must have 2 hours of CE for each month, including the month of enrollment, and 2 hours of ethics every year, which also counts toward your total CE requirement, as we just said. So let's look at an example. Elizabeth became an EA on August 24th, and based on her Social Security number, it was the 3rd year of her enrollment cycle. So she must take at least 10 hours of CE. So that's 2 hours for each month from August through December. So that's August, September, October, November, December. That's 5 months times 2 hours is 10 hours that she has to have, and at least 2 hours of those have to be in ethics. Now, she does not have to get 2 hours in August and 2 hours in September and 2 hours in October, etc. She just needs to get a total of 10 hours. She can get it all in December if she wants to, but she has to have 10 hours, and at least 2 hours of those have to be in ethics. All CE courses must be approved by the IRS and provided by IRS-approved CE sponsors. So in order to become an IRS-approved CE sponsor, you have to fill out an application, you have to pay an application fee, and then you have to submit all of your courses to the IRS for them to approve them. An hour of credit is granted for each 50 minutes of instruction. So they give you credit for a 10-minute break for every 60 minutes that you are working. So 50 minutes counts as an hour. And EAs may earn up to 6 hours annually for teaching qualified courses. You get 1 hour for each hour of teaching, plus 2 hours for preparation for each hour taught. So, for example, teaching a 2-hour course would give you that maximum of 6 hours. You get 2 hours for actually teaching, and then you get 4 hours for your preparation. The CE providers, when you take a course, they will report electronically to the IRS the PTINs and the names of the people who took that course. And even though they do that, though, you are the one responsible for obtaining and keeping the course completion certificates, and you have to keep them for at least 4 years from the date of renewal. You will want to remember that. So it's 4 years from the date of renewal, not the date that you took the course. So if you take the course early on in your 3-year enrollment cycle, you're going to have to keep that for a lot longer than 4 years. You're going to have to keep it for 6, 7 years, potentially, depending on exactly when you took that. Of course, these days, you're going to get these certificates electronically, or even if they give it to you on paper, you can scan it in and keep it electronically. So it's a lot easier to keep than having to worry about keeping it in a paper file. These CE courses can be given in a variety of ways. So first of all, it could be a live course where you actually go to a meeting room. It might be at a hotel and you go to one of their meeting rooms. They make sure you're there. You sign a sign-in sheet, you put down your PTIN, you attend the course. They give you a completion certificate and they send your information to the IRS. You can also attend live webinars online. When you attend these, there will be questions throughout the webinar. You don't have to get the answers right. So it's not a test. They're really attendance checks. They just want to make sure that you're actually there and that you're watching and that you just didn't start the webinar and walk away and you want to get credit for it. So you'll have to answer questions every once in a while to make sure that you are there and that you are paying attention. Then once you finish that, again, you will get your certificate and they will send your information to the IRS. And then the other way you can get credit is with self-study. So you'll read material, you might watch videos, And then at the end of that, you have to actually pass an exam to prove that you went through the information, pass the exam, then you get your credit in your certificate, etc. You can see how much CE has been credited to your account at that same place where you get your PTIN. So once you get your PTIN, you'll have an account with the IRS, and that's where you renew your PTIN every year. And in that same place, you can see how much CE so far that you have gotten. And if there's anything that's missing, then you'll want to contact whoever it was that provided that CE to make sure they report that to the IRS. But that's a good way to keep track of how much you've got, how much you still need to get, etc. There are circumstances under which the IRS will waive your CE requirements. So if you have health issues that prevent you from getting your CE, if you're on active military duty, if you are absent from the United States for employment purposes, not just because you're on vacation, but for employment purposes, or for other reasons on a case-by-case basis. So I would not want to rely on this. You want to get your CE done if at all possible. But if you just can't because of one of these reasons, then you can't. And then you ask the IRS to waive those requirements, and then they may do that at their discretion. Inactive and terminated status. If you do not meet your CE or other renewal requirements, then your enrolled agent credential will be placed in inactive status. You have 60 days from being notified to respond and provide proof of any missing requirements. If you miss a renewal cycle, that 3-year renewal cycle, then you have to pay all the fees for the prior cycle and the current cycle, and you have to provide proof of CE compliance. And you can lose your eligibility to practice before the IRS for not meeting the CE requirements, for not renewing your PTIN, for being disciplined by a state regulatory agent, such as being disbarred or losing your CPA license, or you can actually request for your EA status to be placed in inactive or retired status. When we talk about being disciplined by a state regulatory agency, if you are also a CPA or you are also an attorney, in addition to being an enrolled agent, if you lose that CPA or law license due to being disciplined, then they are also going to take your EA status away from you. Now, if you just voluntarily give up that status, maybe you're an attorney and you don't want to have to take all the continuing education courses that are required to keep that license. You might just give up your law license. That's okay. As long as it wasn't for a disciplinary reason, that will not affect your EA status. Same way with the CPA license. Practitioner duties and restrictions. So this applies to all practitioners who are subject to Circular 230, which of course includes enrolled agents. Information to be furnished. Practitioners must promptly submit records or information to the IRS when lawfully requested, unless the practitioner reasonably believes them to be privileged. So in the next video, we are going to talk about the preparer-client confidentiality privilege, which is similar to an attorney-client privilege. So if the IRS requests documents and you reasonably believe that they are subject to a privilege, either your client preparer privilege or an attorney-client privilege, maybe there is a legal action going on, there's an attorney involved, there could be an attorney-client privilege that those documents are subject to. So if you reasonably believe they are subject to privilege, then you do not have to turn those over. However, most of the time when they are requesting documents, that is not going to be the case. So if the IRS requests something, you must promptly turn it over to them. If you do not have those requested records or that information, but you know who does, or you think you might know who does, then you need to tell the IRS that information. Tell them who has it or where they might be able to find that information. and you may not interfere with a lawful request for records or information. So in other words, you can't destroy documents or hide them or advise your client to destroy the documents. For example, you cannot interfere in any way. Knowledge of a client's omission. So we talked about this in part 1, but let's go over it again. A practitioner who knows that a client has not complied with the tax law or who has made an error or an omission in any tax return or document must do this. First of all, they have to promptly advise the client of the problem, of the noncompliance or the error or the omission. And they have to advise the client of the consequences of not correcting the problem. So you have to tell the client about the problem that, hey, you made an error on last year's tax return. And then you have to tell them what happens if they don't fix it. If you don't fix the error, then you could be subject to penalties and interest, for example. Notice that there is no duty or right for you to report that situation to the IRS or to make that correction without the client's consent. So you do not work for the IRS. So you do not go to the IRS and say, hey, this person didn't do this. That is not your business. You tell the client about the problem. You tell them of the consequences of not correcting the problem, and then the client decides whether or not to correct that. You do not. Now, of course, you can try to persuade them if you think it's something they really do need to fix. You can use all your powers of persuasion, but ultimately, it is their choice about whether or not they correct that. So you don't just go ahead and amend their tax return for them. You ask them if they want to do that, and then they decide. Accuracy and due diligence. Practitioners must exercise due diligence in preparing or assisting in preparing, approving, and filing any documents with the IRS, in determining the correctness of oral or written representations made to the IRS and those made to your clients. So if you are telling the IRS something, you must exercise due diligence in making sure that what you are telling the IRS is factual. And the same way with your clients. If you're telling your clients something related to taxes and dealing with the IRS, you must use due diligence in making sure that what you are telling the client is accurate. Now, you are allowed to rely on others as long as you used due diligence in choosing that person and, if appropriate, in supervising them and training them, etc. So, for example, you may work in a firm and a tax staff person might do some research. They might call and talk to the client. They might gather some facts, and then they present those to you. And then you rely on that staff person when you talk to the IRS. That is perfectly fine. You can do that. You don't have to have personal knowledge that you're the one who actually went out and gathered the information or talked to the client. As long as that staff person is someone you can reasonably rely on and that you are supervising, you can, of course, rely on that information. But you do have to do due diligence in supervising them, and you just have to make sure that whatever you are telling the client or the IRS is factual as best as you know it. There are special due diligence rules. Again, we talked about this back in part 1. We have all of those things that you have to fill out this 8867 for: the American Opportunity Credit, the Child Tax Credit, the Earned Income Credit, and Head of Household Status. Those things, you have to fill out that 8867, and you have to do more due diligence than you normally do. So normally, when a client tells you something, you can rely on it as long as what they are telling you is reasonable. And we'll talk a little bit more about that here in a little while. But as a general rule, if your client tells you something and it seems reasonable, then you can rely on that. You don't have to get documentation. They don't have to prove what they're telling you. But this is an exception to that. If they are taking any of these credits or getting any of these benefits that need the Form 8867, you do need to do more than just rely on the word of the taxpayer. So what does this mean? They call it the knowledge requirement. You have to have knowledge that the person actually qualifies for these tax benefits. So how do you obtain that knowledge? Well, you can do it by interviewing the taxpayer and asking adequate questions, by contemporaneously documenting the questions and answers. So while you're talking to the taxpayer, you're taking notes and documenting what they tell you, by reviewing adequate information to determine eligibility. So if they're going to show you a birth certificate, for example, that proves that they have this child, or they're going to show you school records that proves that they're a full-time student or something like that, you would review that information. And then you must not know or have reason to know that the information being relied on is incorrect. So in other words, if they tell you something or even show you something, but you know that it's not true, or you've got contradictory information to what they're telling you or what they're showing you, then you cannot rely on what they are telling you. And you must make reasonable inquiries if a reasonable and well-informed tax return preparer, knowledgeable in the law, would conclude that the information furnished to the tax preparer appears to be incorrect, inconsistent, or incomplete. So if they tell you something that just doesn't seem right, doesn't seem reasonable, then you need to dig a little further. You cannot just rely on it. And this well-informed tax return preparer, knowledgeable in the law, that through all of part 3, that's what you want to think about. When you are trying to decide what is the right thing to do, this is what the IRS and what the courts are going to look to. They are going to say, what would this well-informed tax preparer who's knowledgeable in the law and the facts of this situation, what would they conclude? And that's the standard that you are going to be held to as well. So if a client tells you something just doesn't seem right, then you need to dig a little bit more. Now, for these 8867 benefits, you need to keep the records, any records that you get, including your notes, for at least 3 years. You'll want to know that for the exams. You want to keep the Form 8867 itself, of course, any applicable credit worksheets or computations that you did to come up with the amounts of the credits, copies of any documents provided by the client. So if you took copies of that birth certificate or school records and so forth, you would keep copies of those for at least 3 years. A record of how, when, and from whom the information was obtained. So who did you talk to? When did you talk to them? And then a record of any other information relied on. So maybe you didn't get a copy of something, but you looked at it, then you would keep a record of that, for example. If you do not comply with this, you as the preparer can face penalties. And we'll talk about those penalties at the end of this video. Prompt disposition of pending matters. So a practitioner may not unreasonably delay the prompt disposition of any matter before the IRS. So you need to take care of things promptly. If the client gets a letter or a notice from the IRS, it will generally give a date to respond. It'll say, for example, respond within 30 days of the date of this letter. So you want to make sure that you respond within that 30 days. Take care of things. Do not delay. Now, if the taxpayer doesn't bring you the notice, you didn't even know about it until after the 30 days has expired, well, that's not your fault. In that case, you want to respond just as quickly as possible. Do not delay. Get that responded to. Maybe not responding within the 30 days, they'll let it slide. Maybe they won't, but you want to get it taken care of as quickly as possible. Now, you might think that this should work both ways, that the IRS should also promptly take care of things, and sometimes they do, and unfortunately, sometimes they don't. It can be frustrating, but no matter how much the IRS might delay, you do not want to be the one that is causing the delay. Assistance from certain persons. So a practitioner may not knowingly employ or accept assistance from, directly or indirectly, any person who has been disbarred or suspended from practice before the IRS. So they're disbarred or suspended. They are not allowed to practice before the IRS. Remember, we talked about what practice means. So they're not allowed to do any of those things, and they can't do it directly or indirectly by, for example, working for you. They're not allowed to do that. You are not allowed to employ them or to accept assistance from them in any way, even if they're not employed by you. You also may not employ or accept assistance from any person who is a former government employee who personally and substantially participated in the matter at hand, which leads us to our next point, which is that a former government employee, as well as their partners and associates, may not knowingly, directly, or indirectly assist a taxpayer if the representation would violate the laws of the United States. So, what this means is they cannot represent a taxpayer in any matter that that government employee personally and substantially participated in while they were employed by the government. So, I think this makes sense. What we do not want happening is that a taxpayer is undergoing an audit, and the revenue agent doing the audit, let's say the taxpayer goes to them and says, "Hey, Mr. Revenue Agent, I want to hire you to work for me. So I'm going to pay you this large salary. Come work for me and then represent me in this audit before the IRS." That is not allowed. That employee, it is illegal for them to turn around and work for the other side. They are not allowed to do that. Now, they can go to work for the client. It's not illegal for the client to hire that revenue agent, but it would be illegal for the revenue agent to assist with any matter that they were involved in while they worked for the government. And then you, as an enrolled agent, also cannot accept assistance from any such person. Notaries. It's fine to be both a notary and a tax practitioner. However, a practitioner may not act as a notary for any documents or oaths with respect to any matter before the IRS in which he is employed or involved in any way. So, for example, let's say there's been an audit. You are representing your client for that audit, and then they need to have a document notarized related to that audit. You cannot be the one who notarizes that document. Fees. Practitioner fees cannot be unconscionable. Now, that's kind of a lawyer word, but it comes straight from Circular 230. You will want to remember that. So your fees cannot be unconscionable. Now, that word is not precisely defined, but fees should be reasonable based on the services provided. So you want to think about it like if somebody saw how much you charged, it would not just shock the conscience to see that. They wouldn't be like, "Oh my goodness, you charged how much for that?" So it needs to be reasonable based on the services provided. Also, in general, you cannot charge contingent fees, such as a percentage of the refund received. So, what the IRS does not want tax preparers doing is saying, "Hey, look, I'm such a good tax preparer. I know I'm going to get you a large refund if I prepare your tax return. So, let me prepare the return and I will take a percentage of the refund." Or what a tax return preparer might do is they might look at the client's information. They might get their W-2s and all of their information, and they might kind of in their head be able to calculate the refund, and they might think, "Wow, this person's going to get a big refund." And so they'll say, "I'll just charge you a percentage of the refund." You cannot do that. And of course, the IRS does not want to give tax preparers an incentive to cheat or to fudge on the tax return in order to get a larger refund for the client and therefore get themselves a larger fee. So you are not allowed to charge contingent fees. Now, there are a couple of exceptions. If the service is related to an IRS challenge or examination of an original or an amended tax return, you can see there on the screen exactly the requirements for the amended tax return. But if you're dealing with an IRS audit and the client comes to you, let's say the IRS sent a notice, and in the notice, they said, hey, taxpayer, you owe $20,000. And the taxpayer comes to you and says, hey, I need help with this. And you look at it and you think, you know what? I think that $20,000, I think that's out of line. I think I can get that reduced. Maybe I can get rid of all of it, or maybe I can at least get it reduced to a smaller number. You can have a contingent fee in that case. You can say to the client, look, I think I can get this reduced, maybe even eliminated altogether. So I tell you what, I will take a percentage of whatever amount I save you. So if they said you owed $20,000, if I get that knocked down to $10,000, then I will get some percentage of that $10,000, for example. That is allowed. Similarly, if the IRS says that the taxpayer owes a certain amount of penalties and interest, and you think you can get those penalties and interest reduced, then you can charge a contingent fee based on the amount of the reduction in the penalties or interest that is allowed as well. And then the final exception is that you can charge contingent fees for services rendered in connection with any judicial proceeding arising under the Internal Revenue Code. So this is aimed primarily at attorneys. So of course, you're probably familiar that attorneys often work on a percentage basis. When they sue someone, they get a percentage of the amount that is recovered. They can do the same thing for tax cases that go to the courts. But if you are not an attorney, then that most likely is not going to apply to you, but you need to know that for the exam. Return of clients' records. If the clients want their records back, you have to give it to them. That's basically what this is saying. So if the client says, hey, give me my stuff back, then you give it to them. However, you do not have to give them your work product or any schedules that you prepared or a tax return that you prepared if you are withholding it pending payment of fees. So if they haven't paid you, you do not have to give them that tax return or anything that you prepared. You do have to give them their documents. So if they gave you W-2s and other documents, you have to give those back, but not anything that you prepared. So what can happen is you prepare a tax return, and let's say the client ends up owing a bunch of money and they don't like that answer. So they say, no, I'm going to go to somebody else and have them prepare my return instead. That's fine. They can do that, and you have to give them their information back, but you do not have to give them that tax return. Conflict of interest. Practitioner must not represent a client if the representation of one client will be directly adverse to another client, or there's a significant risk that representation of one or more clients will be materially limited by the practitioner's responsibilities to another client, a former client, or a third person, or by a personal interest of the practitioner. So let's first deal with this adverse situation. Let's say you prepare a tax return for a husband and a wife. You've been preparing it for years, and now they're getting a divorce. And one or the other of those spouses comes to you and wants you to help represent them in the divorce and prepare some calculations, maybe even act as an expert witness in the divorce. You cannot do that because obviously that would be adverse to their spouse who is also your client. Or maybe you do the taxes for a corporation and also the CEO of the corporation. Now the CEO is leaving. There's some bad blood. Maybe there's a lawsuit, and either the CEO or the corporation asks you to help assist in that litigation to provide financial support to the attorneys. Again, you would not be able to do that. And then anything else where there would just be a conflict, where you might feel limited or restricted in representing a client because of some conflict with another client, with a family member, with yourself. Maybe there's a partnership and you are a partner in the partnership, and now there's some sort of legal action involving that partnership, and somebody wants you to represent them. Well, obviously, you're a partner in the partnership. There's going to be a conflict, or you might have a family member who is. So basically, if there's anything that just doesn't feel right, like, you know what, there's too much of a connection here between me and what this client is asking me to do, then likely you've got a conflict of interest, and then you would have to turn that down. Now, there is an exception, of course, to this as well. Even if there is a conflict, so any of these type of conflicts, you can represent the client if you believe that you can provide competent representation. The representation is not illegal under, for instance, state law, and all the parties acknowledge the conflict and consent in writing to your representation. So let's say you've got that married couple, they're getting divorced. One of them asked you to help, and you say, no, sorry, I can't do that. But let's say the other spouse says, that's fine. I know this tax preparer. They've always been good. They've always been fair. I'm not worried about them doing anything wrong. It's fine for them to help my spouse with this divorce. Well, as long as it's all stated in writing, everyone agrees to it, everybody signs off on it, and you want to do it and you feel comfortable doing it, then you can do that. And then for the exam, you will want to know that the copies of those consents must be retained for at least 36 months or 3 years. You have to retain those. Advertising. A practitioner may not use any advertising or public communication containing a false, fraudulent, coercive statement or a misleading or deceptive statement. You will want to remember all of that for the exam. So no advertising or public communication. So these days with social media, it's easy to put something out there that you really didn't think about. So you want to be very careful about what you are posting. So you cannot say anything that's false, fraudulent, or coercive, misleading, or deceptive. Also, enrolled agents cannot use the term certified or imply that they are employees of the IRS. So you can't say I'm a certified enrolled agent. That is not allowed, or in any way to make people think that you work for the IRS. Now, what can you say? You can say enrolled to represent taxpayers before the Internal Revenue Service, enrolled to practice before the Internal Revenue Service, admitted to practice before the Internal Revenue Service. Those things are fine, but don't use the word certified. A practitioner may not use any official IRS insignia, such as those shown at the top part of the screen here. So this one is usually known as the IRS Eagle. You cannot use that in any of your advertisements or public communications. And then you have this other one as kind of the scales of justice here. But any of those or any other ones that are official IRS logos, you cannot use. Now, if you are an authorized e-file provider, you can use those e-file logos that are shown on the bottom part of your screen. We will talk more about that in video number 4 of part 3. Fee information. So before we talked about the amount of fees that you can charge, now we're talking about advertising your fees. So a practitioner may publish a fee schedule to disseminate the following information: fixed fees, hourly rates, ranges of fees, fees charged for an initial consultation. You can do all of that. But if you do that, you can charge no more than those published rates for at least 30 calendar days after it was last published. So, for example, if on your website you have something that says free initial consultation, you have to offer a free initial consultation for at least 30 days after the last time that appeared on your website. If you run a Facebook ad and you say, new clients, I will prepare your tax return for $50 or something, that's fine. You can do that, but you can't charge a new client more than $50 to do the tax return for 30 days after the last time that Facebook ad ran, for example. And then you must keep a copy of the advertisement for at least 36 months, again, after it was last published. So again, you'll want to remember that. So you want to maybe keep an electronic copy of your website, keep a copy of that Facebook ad or whatever it might be, but you have to keep it for at least 36 months. Solicitation. A practitioner may solicit business, such as through mailers, if it is allowed by state law. Now, I am not aware of any state that does not allow tax practitioners to solicit business. It used to be that attorneys and CPAs were not allowed. It was illegal for them to advertise, believe it or not. You would never think that today. Go to any town in the United States, you're going to see billboards from attorneys, as well as television ads and radio ads and online ads, et cetera, and so forth. But there was a time when that was actually illegal. That doesn't exist anymore. So you are allowed to solicit business. You can put up a billboard, you can run an advertisement, you can send mailers, you can go door to door and solicit. All of those things are allowed as long as it is legal. Any solicitations that you use must clearly identify it as a solicitation, that it is an advertisement, and if applicable, provide the source of the information used to select the recipient. So if it's a mailer, for example, you need to disclose how you got their information in order to mail it to them. And then all solicitations have to meet all the same requirements that we talked about. So it can't be misleading or false or coercive, etc., and so forth. Negotiation of taxpayer checks. A practitioner may not endorse or otherwise negotiate any check issued to a client by the government in respect of a federal tax liability. This specifically prohibits directing or accepting payment by any means. So it's not just paper checks we're talking about here. When we say negotiating a check, it includes electronic payments, but you may not direct or accept any payment into an account owned or controlled by you, your firm, or any entity with whom you are associated. So this is one of the nevers. You don't have a lot of nevers when we talk about the tax law and all of these rules. This is one of those nevers. You never negotiate a taxpayer check. You never direct or accept payment into your bank account or to a related bank account. It is not allowed. Now, for some reason, there are tax preparers out there who want to tell their clients, I tell you what, let's just put your refund into my account, then I will subtract out my fee and give you the rest of the money. No, no, and no, that is not allowed. Now, I know you might be thinking, but what if I've got a client, they're poor, they don't even have a bank account? Can't I do that for them as a service to them? No, you cannot do that. There are other ways for them to get paid. For instance, they can get a debit card from the IRS. We'll talk more about all of that in video 4. But you do not direct that money into your bank account, even if the client asks you to do it. Doesn't matter. You cannot do it. Practice of law. Nothing in these regulations, so all of Circular 230, when it's talking about all of these rights and responsibilities that you have as an enrolled agent, none of that can be construed as authorizing non-attorneys to practice law. So if you are not an attorney, you cannot practice law. You will want to remember that. Best practices. Tax advisors should provide clients with the highest quality of representation by adhering to best practices in providing advice and in preparing or assisting in the preparation of a submission to the IRS. Best practices include the following. This is just an example, and best practices can change over time as technology improves and so forth. These can change, but this is an idea of some of the best practices. Communicating clearly with the client about the terms of the engagement. So oftentimes we actually use an engagement letter that spells out everybody's rights and responsibilities, how much the fee is, et cetera, and so forth. Establishing the facts, determining the facts, evaluating the reasonableness of any assumptions, relating the applicable law to the facts, and arriving at conclusions supported by the law and the facts. advising the client regarding the import of the conclusions reached, including whether a taxpayer may avoid accuracy-related penalties by relying on the advice. So we're going to talk about penalties and disclosing things in order to avoid penalties. So you always want to be advising the client of all of those types of things. And of course, acting fairly and with integrity in practice before the IRS. So that's the thing you want to think about always. Is you want to always act fairly and with integrity, both with your clients and with the IRS, using common sense, being a good business person, and just being a good human being will make sure that you are always using best practices. Supervising others. If you are supervising others, you need to make sure that they are following all these rules as well. That's what this is saying. You are responsible for anybody that you are supervising. You want to make sure that there are processes in place, that there are procedures in place, that that person is trained, that they're following all these processes and procedures. And if they don't, you as the supervisor can be held liable for that. Standards with respect to tax returns. So a practitioner may not willfully, recklessly, or through gross incompetence sign a tax return or a claim for refund, or advise a client to take a position that lacks a reasonable basis, that is an unreasonable position, that is a willful attempt to understate a liability, or is a reckless, intentional disregard of the rules and regulations. And when the IRS is looking at this, a pattern of conduct is a factor that will be taken into account in determining whether or not the practitioner acted willfully, recklessly, or through gross incompetence. So if you do something once, you make a mistake one time, that is not likely to get you in trouble as far as this is concerned. Obviously, if you've committed a crime or something like that, you could still have a problem. But if we're talking about you just one time made a mistake, you don't have to worry about this. But if you have a pattern, so we've had tax return preparers in the past who kind of gone off the rails, and they've had all these clients and they start making up businesses that don't exist and taking big business losses, taking credits that the clients have no right to, et cetera, and so forth. And they do this over and over and over again. That would be willful, reckless, and or through gross incompetence. And those people are going to have a problem. So tax return positions, when we say it can't be unreasonable, and you have to have a reasonable basis for taking a position, what does that mean? Well, the tax law is not always black and white. As we've gone through this course, I have been presenting to you the law, and I've been saying things like this income has to be included, this income is not included, these deductions can be taken, these deductions cannot be taken. And I've given you a lot of black and white rules. So you may have the impression that the tax law is always black and white, and it is not. The reason I have done that in this course is because you are trying to pass an exam, so you need to know the rules. So when the IRS puts together the EA exam, it is going to be on black and white issues. They are not going to give you any questions where there's some gray area and maybe you could answer it this way and maybe you could answer it that way. That is not going to happen. On the EA exam, there is going to be a correct answer. So it is going to be black and white. But when you are working with clients, that is not always going to be the case. There are going to be times, a lot of times actually, when you look at something and you're like, you know what? I'm not really sure. If I look at it this way, I could see where, yes, this is deductible. But if I look at it from this standpoint, I don't really think it is deductible. So what do you do? How do you know if a position that you are taking is reasonable or not? How do you know if you're going to get some type of penalty for taking a position on a tax return that is not reasonable, or that you might face a fine or other sanction for doing something that is not reasonable? Well, the IRS does have a framework that they use. Now, it is still subjective. It's not like it's all black or white, but it's something for you to use, and you will want to know this for the exam. So they have these terms that you'll see here: reasonable basis, 25%. So what that means is when a reasonable and well-informed analysis by a person knowledgeable in the tax law concludes that there is at least a 25% likelihood a position would be upheld on its merits, then that will be considered a reasonable basis to take that position. You can take that position on a tax return. However, you must disclose it to the IRS. So when you file that tax return, you have to disclose to the IRS. You have to say, in essence, hey, IRS, we are taking a position on this tax return that only has about a 25 or 30% chance of being upheld if it is looked at. So in other words, if the IRS audits it or if it goes to court, it's only about a 25% chance that we will win, that we, the taxpayer, will win on this issue. But it's a reasonable basis. You don't have to worry about it being a willful, reckless, etc. position. You at least can say you had a reasonable basis for taking that position. Next up on the line here is realistic possibility of success. So this is when you think you have about a 33% chance. You think about one time out of three, I think that we will win if this issue is audited or goes to court. You can, of course, take that position on the tax return, and you do not have to disclose it. However, if you don't disclose it, the IRS could determine that it was unreasonable, and there could be a penalty to you and to the taxpayer for taking that position. You can avoid those penalties by disclosing it. So you don't have to disclose it. But if you do disclose it and you lose, then you don't have to worry about those penalties for taking an unreasonable position. Next is substantial authority. So this is 40 to 50% chance of prevailing. Again, you do not have to disclose it, but if you do, you can avoid the penalties that would be associated with not disclosing it. And then finally is more likely than not. So this is a greater than 50% chance. In that case, again, don't have to disclose it, though you can avoid penalties by disclosing it. So for the exam, you will want to remember these four categories and the percentages: reasonable basis, 25%, realistic possibility of success, 33%, substantial authority, 40 to 50%, and more likely than not is greater than 50%. So if you disclose, how do you do that? Well, you make that disclosure usually on this form 8275 or 8275R. As we said, the disclosure can help you avoid penalties, preparer penalties, and taxpayer penalties. However, it will not avoid penalties that are attributable to negligence, disregard of regulations, or a substantial understatement of tax on a tax shelter item. So you can't just take any position on a tax return, disclose it, and avoid the penalties. You have to meet that framework. You want to be at least at that 25% level. And again, it's what would a reasonable, well-informed tax preparer who is knowledgeable in the law, knowledgeable of the facts and circumstances, what would they conclude? You want to be at least at that 25% level. If you're below that, disclosing it is not going to get you out of these penalties. Or if it is a substantial understatement of tax related to a tax shelter item, which leads us to our next topic, which is tax shelters. Very broadly, a tax shelter could be defined as any plan or device to reduce income tax liability. So under that definition, contributing to a 401k plan or an IRA or making a charitable contribution could technically be considered a tax shelter. But when we're talking about tax shelters, as far as all these penalties and disclosures, etc., that's not what we mean. Instead, we're getting into the territory of abusive tax shelters or gray areas where maybe it's an abusive tax shelter. So, what is an abusive tax shelter? Well, it is something that is set up primarily to lower tax with little or no economic substance or purpose aside from the tax savings. Or, as this professor said, it's a deal done by very smart people that, absent tax considerations, would be very stupid. In other words, nobody would do this deal if they were not getting the tax breaks. So sometimes you can have some very smart lawyers and CPAs who look at the rules. So they look at this statute over here, and they look at this other statute over there, and a third one over here, and they look at the exact wording of those statutes, and they are able to put together some sort of deal in all the paperwork and contracts and everything else that maybe if you only looked at the exact words, maybe it would actually pass muster and it might quote unquote work. However, there is an overall concept in the tax world called substance over form. So if you've got a transaction that has little or no economic substance, it doesn't matter how you've set it up. It doesn't matter what the contracts say. The IRS and the courts are going to look at the substance of the transaction. What actually happened? If you have a transaction that has no economic substance but provides huge tax benefits, you are likely going to be in trouble. You are not going to prevail. This is kind of a common sense argument that anybody who looks at this would know that you would never have entered into this transaction except for these tax benefits. The tax law is supposed to be taxing transactions that people enter into because they think it's a good business deal to enter into it. You should not be inventing transactions in order to get the tax benefits. So, for example, sometimes people will put together these complex partnerships and trusts that have to do with oil exploration so that they can get large depletion deductions, even with no risk to the taxpayer. Or they might be large real estate partnerships with all kinds of contracts and rental agreements where the owners get large depreciation deductions, but they essentially have no risk of actually losing any real money. Now, does that mean that every oil exploration partnership is an abusive tax shelter? Of course not. Does it mean that every real estate partnership is? Of course not. There's thousands and thousands of these that are perfectly legitimate. But there are some that are not, and they are abusive tax shelters. And then there are some that are just in a gray area, or some that the IRS wants to take a close look at. So if they've got a entity that's in one of these areas that the IRS has identified, and those can change over time, but if it's in one of those areas that they've identified as a potential to be an abusive tax shelter, then the IRS wants to take a closer look at that, and they're going to scrutinize it more closely. So certain transactions related to tax shelters or potentially abusive tax shelters are called reportable transactions or listed transactions, which means they have to be reported to the IRS. And you do it on this form 8886. And these transactions are always subject to the more likely than not, the greater than 50% chance of prevailing standard. So you cannot take a position on a tax return of less than 50% confidence that it will prevail if it involves a tax shelter item. So remember, we said you can go as low as 25% and still take that position on the return as long as you disclose it. That does not apply to a tax shelter item. If it's a tax shelter item, you do have to disclose it on this 8886, and it has to be more likely than not that the taxpayer would prevail if it is looked at later. When taking a tax return position, not just on a tax shelter item, but any tax return position. How do you look at it and determine whether it's got a 25% or 33%, et cetera, chance of prevailing? Well, you're basically going to look at the law, and then you are going to apply the law to the facts. So you're going to look at all of these things, and there could be other things as well. You're going to look at the tax law, which is the Internal Revenue Code. You're going to look at the Treasury regulations, legislative history, court cases, et cetera, and so forth. We are going to go into these in detail in the next video. But for now, just know this is how you're going to have to do research, and you're going to have to determine, do I think will prevail based on the law and all the rules that are put out by the IRS. Standards for documents. You as a tax practitioner may not advise taking frivolous positions. You may not advise submissions to delay or impede tax administration that are frivolous or containing or omitting information that demonstrates an intentional disregard of rules and regulations. So what this is getting at mostly is the tax protester arguments. So there are groups of people out there who believe that the income tax is illegal, and they've got all kinds of different theories about why it is illegal. So for example, there are people who say that the 16th Amendment that authorized the income tax, that when it was passed, there was not a quorum in Congress. So you have to have at least so many representatives or senators in attendance and voting in order to have a quorum in order to pass something. And they contend that this quorum was not met when the 16th Amendment was passed. Therefore, the 16th Amendment is not legitimate. It's not really part of our Constitution. Therefore, the income tax is illegal. Well, I'm not an expert on the quorum rules and all of that, but what I do know is that the Supreme Court has ruled that absolutely it is legal, and the courts have ruled this over and over and over again because these types of cases have been brought up over and over again. And it's not just that, there's other arguments that people have. They'll come up with lots of things. They might even sound convincing. You might watch a video and think, yeah, that makes sense. Well, I can tell you that the courts have said, no, it does not make sense. These come up all the time, and the courts are tired of dealing with them because they just gum up the system is all they do, because the people are not going to win. So they're going to take up everybody's time. They're going to be filing these lawsuits. It wastes the court's time. It wastes the judge's time. It slows everything down. And so these judges will come down hard on these people who make these frivolous arguments. I remember back in the late 1980s and early 1990s going to bookstores. I'm talking about large bookstores like Barnes & Noble. And they would have prominently displayed, like on a table in the middle of the aisle, the main aisle of the bookstore, all of these books by this guy who was saying you don't have to pay income tax. I forget the exact name, but it was something like How Anybody Can Stop Paying Income Taxes or something like that. It's a big book with a yellow cover. And I was a young tax guy. And I remember looking at this and thinking, this doesn't make any sense. So that guy's name was Irwin Schiff. He's one of the most famous people in this tax protester movement. He's considered a martyr for the cause. So whatever happened to Irwin Schiff? Well, I can report to you that he died in prison. He was in prison for tax evasion and for promoting tax evasion. So all of these tax protester arguments, you cannot do anything to forward them. You cannot submit any of these frivolous tax returns. You cannot advise a client to do that. If clients want to do this, if they want to be martyrs and go to prison for the cause, that is their business, but you want nothing to do with it. Sometimes they want to file a return, but they want to show that they're protesting. So they'll file a blank tax return. They'll cross out the portion that says that they're signing this under penalty of perjury, and they'll write in the income tax is illegal, and they will submit their tax return, for instance. You want nothing to do with that. You don't do it. You don't advise people to do it. If somebody comes to you with this, you just say, I'm sorry, I can't help you, and then you move on. Advising clients on potential penalties. So we've talked about this before. You must advise the client of potential penalty exposure regarding a position taken on the return and any document, affidavit, or other paper submitted to the IRS. So if you're taking a position on the return that might result in a penalty, then you need to tell the client that, hey, look, here's the position. I think we've got 25, 30% chance of prevailing if it's audited. We have to disclose it on the tax return. Do you, the client, want to take this position or not? And then it is up to the client to decide that. Or maybe it's a higher, maybe you're a greater than 50% chance of winning. You think you'll probably prevail if this gets audited, but you're not 100% sure. You still need to tell the client, look, I think we're on the right side of this issue. If it's audited, I think that we will prevail, but there's a chance that I'm wrong. And if I'm wrong, there could be penalties involved, and you need to know about it. We can avoid those penalties if we disclose the position. So then let the client decide, do they disclose the position or not? And do they take the position or not? If it is a smaller percentage, if it's greater than 50%, you're probably going to be comfortable taking that position. If it is like the 33% position where you don't have to disclose it, remember, you could also be subject to penalties. So you and the client could have penalties. So you always want to tell the client this, but you have to think about yourself in that case as well. So the client has to decide, okay, do we take this and do we disclose it? But you also have to decide. If you think, okay, I'll take the position, but I want to disclose it because I don't want to be penalized, you need to tell the client that. If the client doesn't agree, then they're probably going to have to find a new tax preparer. Now, that's the exception. Most of the time, you guys will agree that, okay, yes, we will go ahead and disclose this, or no, we won't disclose it, and you can be on the same page. But if you're not on the same page, then there can be times when you could have to step away from a client engagement. Reliance on client representation. So we talked about this before. You may generally rely in good faith without verification upon information furnished by the client. Now, of course, we had those exceptions for those Form 8867 items. But in general, you can rely on it. You don't have to ask for receipts or proof of any kind. However, you cannot ignore the implications of information furnished to or actually known by the practitioner. So if you know something contrary to what they are telling you, then you can't ignore that. And you can then not rely on what they are telling you. And you must make reasonable inquiries if the information appears to be incorrect, inconsistent with an important fact, or incomplete. So again, we talked about this before. Something just doesn't seem right, then you need to ask more questions. And in some cases, maybe even ask for documentation. Competence. A practitioner must possess the necessary competence to engage in practice before the IRS. Competent practice requires the appropriate level of knowledge, skill, thoroughness, and preparation necessary for the matter for which the tax practitioner is engaged. So this idea of competence is the same in all professions, whether you're talking about lawyers or doctors or tax preparers or architects, etc. You should always be competent to do what you are doing. So let's take an example outside of tax preparation. Let's say that you need brain surgery and you have a friend and she is a physician. And you go to her and you say, hey, look, I need brain surgery. Can you do this brain surgery for me? And she says to you, well, you know, I'm a cardiologist. I do heart surgery. I am not competent to do brain surgery. You need to go to a neurosurgeon. Well, of course, that's kind of a ridiculous example, but if you didn't know the difference between different types of physicians, maybe you would make that mistake. And of course, she is doing in this case exactly what we want her to do, right? If somebody came to her and said they wanted brain surgery, we would hope that she would say, sorry, I can't do that. Not my specialty. You need to go to a neurosurgeon. Same way with a lawyer. If you're being charged with murder and you go to a divorce lawyer, you would hope that the divorce lawyer would say, look, not my expertise. You need to find a criminal defense attorney. Well, the same idea applies to you as a tax preparer. If somebody comes to you with something that you just know nothing about and is a very specialized area, for example, then you need to say, hey, look, not my area of specialty. You need to go to someone who is, and maybe you can point them in the right direction. Now, does that mean that you can't do anything that you've never done before? No. So, what we say here is that a practitioner may become competent for the matter for which they are engaged through various methods, such as consulting with experts in the relevant area or studying the relevant law. So, maybe you can take a continuing education course on the topic. You can talk to experts. You can study up on it, and you can become competent in it in a fairly short period of time. That is perfectly fine. But if you get into it and you start studying it and you're like, oh, wow, this is a lot more than I was expecting. I cannot become competent in this in a short period of time. That's when you need to say, look, you need to talk to someone else. And in their defense, clients, especially with tax preparers, most people are going to know that a cardiologist isn't going to do brain surgery, right? They're going to know that a divorced lawyer is not going to handle a murder case. But when it comes to tax preparers, they're not going to know that this tax preparer doesn't specialize in a certain area. They're just going to assume that everybody can do everything. But there are some very special areas of tax law that people spend a lifetime becoming experts in that you are not going to become an expert in just a few hours. So you can refer them to people who can help them. And wouldn't you want to do that anyway? Do you want to take on a job that you're not going to do a very good job at? Your client's going to be upset. You're going to get a bad reputation, and you're just going to feel bad about yourself. You don't want to do that. Refer them out. The person you refer them to will be grateful for the referral, and maybe they'll give you a referral in the future. So again, use your common sense, do the right thing. Don't get in over your head, and make sure that you are competent to do what you have been engaged to do. Written advice. So when you are giving written advice in any format, that can be a letter, an email, a text, a social media post, any type of written advice, you must base that advice on reasonable, factual, and legal assumptions. You have to consider all of the relevant facts and circumstances. You have to use reasonable efforts to identify the relevant facts. You can't just say, well, I don't want to know. You have to use efforts to identify the facts. You cannot rely on any representation, statements, findings, or agreements of the taxpayer or anyone else if reliance on them would be unreasonable. You have to relate the applicable law and authorities to the facts, and you cannot take into account the possibility that a tax return or issue will not be audited. So in other words, you can't say, I think that you're wrong here, and I think that what you did is not correct, and you don't have a leg to stand on, but you probably won't get audited, so you might as well just roll the dice and take your chance. You cannot do that. If something is wrong, it's wrong. You need to give advice accordingly and not take into account whether or not that person may or may not be audited. Relying on others. Remember, we said you cannot rely on others if it would be unreasonable to do so. So what does it mean to not be reasonable to rely on others? Well, if you know or should know that the opinion of the other person should not be relied on, or that that other person is not competent or lacks the necessary qualifications to provide the advice that they're giving, or that that other person has a conflict of interest. So back in part 2, when we talked about depreciation, we said that some companies, when they're buying a large building, will actually hire a firm, like an engineering firm, to do a cost segregation study, where they will look at this building and they will say, these components, this amount of components, are personal property and can therefore be depreciated over a short period of time. And these other components are real property. They're a part of the actual building itself, and they are going to be depreciated over 39 years. That can save the taxpayer a lot of tax money, because if they just called the whole thing building, they would have to depreciate the whole thing over 39 years. But if there's a lot of things in that building that are actually personal property, they may be able to deduct all of those currently, or at least over a shorter period of time than 39 years. So they will do that. And of course, you, as the tax return preparer, can rely on a qualified engineering firm who did that study. That is no problem. But let's say you have a client that bought a building and they say, well, my brother-in-law is a handyman and he said this is personal property and this is real property. Well, would it be reasonable to rely on that? Well, no. First of all, it's the guy's brother-in-law, so it's got an obvious conflict of interest. And secondly, all we know about this person is that they're a handyman. As far as we know, they don't have any qualifications to do a cost segregation study. So it would not be reasonable to rely on that person. And when evaluating whether or not a practitioner has violated this requirement, they're going to use this reasonable practitioner standard that we have talked about before. Sanctionable acts. So when can the IRS fine or otherwise sanction a tax preparer? That's what we're going to talk about next. If a practitioner has been found to violate Circular 230, so all of these things we've been talking about are from Circular 230, which again, you need to get a copy of that and read it. But if a practitioner has been found to violate Circular 230, the IRS's Office of Professional Responsibility, or OPR, can impose various sanctions. The lightest or lowest level of sanction that they can impose is called a reprimand. So this is just a private letter from the OPR to the practitioner that says, hey, you did this, you shouldn't have done it. That is not publicly known. No one else needs to know about it. The next level is a censure, which is a public reprimand. So that is a letter saying, hey, you did this, you shouldn't have done it. And it is published in the Internal Revenue Bulletin, or IRB. The IRB is published weekly. We will talk about it more in the next video. It has lots of things in it other than just IRS sanctions of practitioners, but it does include these sanctions. Next is a suspension from practice before the IRS. So this can be up to 60 months. Then there's a disbarment from practice, which is for at least 60 months. So suspension is up to 60 months. A disbarment is at least 60 months. And if someone is disbarred, it is possible in certain cases that they may be reinstated if fitness to practice is restored. And in addition to these sanctions, there can also be on top of it a monetary penalty. So that can be imposed for any of these except a reprimand. So for the reprimand, no monetary penalty can be imposed, but for any of the others, there can be a monetary penalty in addition to the censure, the suspension, or the disbarment. And the amount of that penalty can be up to the gross income derived or to be derived from the misconduct. So if you were accepting fees, it would be the amount of fee that you got or that you would have received. That is the maximum amount that the penalty could be. If you were stealing money, then the penalty could be up to the amount of money that you stole and so forth. What violations are subject to sanctions? Well, if the practitioner is shown to be incompetent or disreputable, and we're going to talk extensively about that here next, if the practitioner fails to comply with the regulations in Circular 230, except for the best practices, so you should do the best practices, but you cannot be sanctioned for not doing the best practices, or with intent to defraud, the practitioner willfully and knowingly misleads or threatens a client or prospective client. That can also lead to a sanction. So now let's talk about what it means to be incompetent or to have disreputable conduct. First of all, a conviction of any criminal offense under federal tax laws, a conviction of any criminal offense involving dishonesty or breach of trust, a conviction of any felony under federal or state law where conduct involved renders the practitioner unfit to practice, giving false or misleading information or participating in any way in giving false or misleading information to the Department of Treasury or any officer or employee thereof. Solicitation of clients in violation of Circular 230, or the use of false or misleading representations to deceive a client or prospective client, or intimating the ability to improperly obtain special consideration from the IRS. So you can't say, look, I know these people over at the IRS, they're my friends, I can get you a good deal, so you should hire me. Not allowed to say that or to imply that. Willfully failing to file a federal tax return or evading or attempting to evade tax. So if you have a tax return that is due, could be an income tax return, could be a payroll tax return, any return, if you willfully fail to file that return, that will be considered incompetence and disreputable conduct, and you can be sanctioned for that. Willfully assisting, counseling, or encouraging a client or prospective client to violate federal law or evade federal taxes. Misappropriation of funds received from a client for the purpose of paying taxes or other obligations due to the United States. Attempting to influence an IRS employee by the use of threats, false accusations, duress, or coercion, by the offer of any special inducement or promise of an advantage, or by the bestowing of any gift, favor, or thing of value. So you cannot threaten or bribe an IRS employee. That's what this is saying. Disbarment or suspension from practice as an attorney or a CPA. If you are an attorney or a CPA, remember Circular 230 is not just about enrolled agents. It's about attorneys and CPAs as well. So if that attorney or CPA loses their license due to some disciplinary proceeding, then they can also be sanctioned by the OPR. Knowingly aiding or abetting another person to practice before the IRS during a period of suspension, disbarment, or ineligibility. So again, you cannot accept any advice or assistance from anybody who has been disbarred or suspended or is otherwise ineligible. If you do, then you can be sanctioned. Contemptuous conduct in connection with practice before the IRS. So that includes the use of abusive language, knowingly making false accusations or statements, or circulating or publishing malicious or libelous matters. So you're going to spread lies and rumors about some IRS employee, maybe. Cannot do that. You can be sanctioned for that. Willfully failing to sign a tax return when required. If you are hired to prepare a tax return, then you need to sign that tax return. Willfully disclosing or using a tax return or tax return information unless compelled to do so by law. Remember, you have confidentiality. You are not allowed to disclose or use the tax return or any of the information unless you get a subpoena or something. We'll talk about that in the next video. Willfully failing to e-file a return when required to do so. So in video 4, we'll talk about e-filing and when you're required to do that. But if you willfully fail to do that when you're supposed to, you can be sanctioned. Willfully preparing or signing a tax return without a valid PTIN. Remember, anyone paid to prepare tax returns has to have a PTIN. Willfully representing a taxpayer before the IRS when not authorized to do so. Next, giving a false opinion, knowingly, recklessly, or through gross incompetence. You can be sanctioned. What does that mean? It is a knowing misstatement of fact or law. It is an assertion of a position known to be unwarranted under the law, including frivolous returns and assertions. So if you know something just isn't right, and yet you take that position anyway, you can be sanctioned. Counseling or assisting in illegal or fraudulent conduct, concealing matters that are required by law, and consciously disregarding information indicating material facts are false or misleading. So you can't just put your head in the sand, act like it doesn't exist. If you know it exists, you have to take it into account. And again, a pattern of conduct will be taken into account in determining this. Making a mistake one time, probably not a problem. Doing it over and over and over again probably is willful and knowing, or at least reckless or incompetent. And so you can be sanctioned. Gross incompetence includes conduct that reflects gross indifference, inadequate preparation, and a consistent failure to perform obligations to a client. So, again, if you are just chronically unprepared, you're not paying attention, you're just not doing your job, then you can be sanctioned. Complaints against practitioners. So, disciplinary cases against practitioners are usually the result of either a referral from an employee of the IRS or from a taxpayer. An IRS employee who believes that a practitioner has violated Circular 230 is required to file a written report to the OPR. So, if IRS agent, you're dealing with them and they reasonably believe that you have violated Circular 230, they have to report that. And a taxpayer may file a complaint against a practitioner on this Form 14157. If they do that, their name, the name of the person making the complaint, will not be shared with the practitioner. Even so, they don't have to put their name on the form if they don't want to. So they can fill out this Form 14157, put their name on it or not, and submit it, and the practitioner will not know who submitted that form. Once a complaint has been made, then the OPR will investigate. If, once they investigate, they believe that a violation has occurred, then the practitioner will be given a written pre-allegation notice. And the practitioner gets the chance to respond and provide documentation. If after they do that, the OPR still believes a violation has occurred, then they will recommend an appropriate sanction and they will try to reach an agreement with the practitioner. And the practitioner can have an attorney involved here if they want to. But what will happen is the OPR will say, okay, we think there's a violation. They put out this pre-allegation notice. Practitioner responds to the notice. The OPR says, well, we still think you committed a violation, and here is the sanction that we are recommending. And then they will negotiate somewhat in some cases, depends on the circumstances, of course. But they may negotiate, and you can try to get a lower sanction or try to get it removed if possible. But if they do that and they cannot agree, then the OPR will draft a formal complaint, and then they will refer that case to the Office of Chief Counsel. Then the practitioner will have one final chance to resolve it before there is a formal disciplinary hearing. So again, now they've issued this formal complaint. You can go back, try to resolve it again. And if you can't resolve it, then it's going to go to a formal disciplinary hearing. When that formal complaint is issued, it has to be specific as to what's being alleged and to the recommended sanction. So it can't just say this practitioner is incompetent. That's not good enough. It has to specifically say, what did the practitioner do that made them incompetent, for example, and it has to give actual factual violations that occurred. Once they do that, the practitioner has 30 days to respond. They have to give at least 30 days to respond. And you want to remember that number. The practitioner has to honestly respond to each allegation, either affirming it or denying it. Because if they don't respond at all to any or all of the allegations, then they are admitting that they did it. So if you don't respond, that is the same thing as affirming that, yes, I did this. Once that is done, there will be a hearing scheduled with an administrative law judge, or ALJ. And the standard of proof in that hearing is clear and convincing evidence. It is not proof beyond a reasonable doubt. At that hearing with the ALJ, the practitioner can represent themselves or they can have an attorney there in the process. my recommendation would always be to have an attorney. When they have these hearings, by the way, they are typically done on video, like via Zoom or something like that. So it's not actually done in a courtroom generally, but you can still have an attorney to represent you. Once the hearing has been held, the judge has 180 days to make a decision. You'll want to remember that number. And once they do, either side, either the government or the practitioner, can appeal within 30 days. I will just tell you for the exam, anytime there's a question about how long does somebody has to appeal something, if you don't know for sure what the answer is, 30 days is a pretty good guess. So if you just had to guess 30 days. Obviously, you want to know the actual answer, but frequently, anytime somebody needs to appeal something, they're given 30 days. So it's a good rule of thumb to follow. But in any case, for the exam, remember the 180 days and the 30 days. The first appeal, so if one side or the other appeals, the first appeal is to the Treasury Appellate Authority. If the practitioner loses at that level, so if the Treasury Appellate Authority says, nope, we find in favor of the government, then the practitioner can appeal to the courts. They can go to the U.S. District Court. If the Treasury Appellate Authority finds in favor of the practitioner, the government cannot appeal. The case is over. So if the Treasury Appellate Authority says, no, we side with practitioner, then practitioner wins, case is over. Suspension or disbarment. While a practitioner is suspended or disbarred, they may not practice in any capacity before the IRS. Remember, we had reprimand, we had censure. If you are reprimanded or you are censured, you can still practice before the IRS. But the next level is suspension and then disbarment. Either of those, you cannot practice before the IRS during the length of time of your suspension or disbarment. However, there are certain things you are still allowed to do, and you will want to know these. First of all, you can represent yourself. So practitioners can always represent themselves in any tax matter, even if they are disbarred or suspended. They can still prepare tax returns for compensation. So it used to be the IRS said, no, you cannot do this. But this was challenged, and there was a court case, the Loving case, and the court said, yes, they can still prepare tax returns for compensation. Now, of course, they would not be able to represent the taxpayer anywhere beyond that, but they can still do the tax return. They can still appear before the IRS as a fiduciary if legally authorized. So if they're the trustee of a trust or something, they can appear before the IRS in that capacity. They can appear as a witness for a taxpayer. They can furnish information at the request of the IRS, and they can receive information from the IRS pursuant to a valid tax information authorization. We'll be talking about those more in the next video, but they can still receive information if the client has given them permission to do so. Preparer penalties. As we've said, preparers can be subject to penalties on improperly filed or fraudulent returns. There are a number of specific penalties that can be imposed for various infractions, so we are going to talk about those. First, we need to understand the definition of substantial understatement. What is a substantial understatement? Well, it means an understatement of the net tax payable or an overstatement of the net amount creditable or refundable. So a substantial understatement, notice it doesn't have any dollar amounts or anything like that associated with it. If it is an understatement of the net tax payable or an overstatement of a refund, it is a substantial understatement. There are a couple of different types of substantial understatements. The first is a substantial understatement due to an unreasonable position. When the preparer knows or should have known the position was unreasonable and would not be sustained on its merits, the penalty for that is the greater of $1,000 or 50% of the income the preparer received or would have received for preparing the tax return. And as we discussed, that penalty may be abated if the position is disclosed on the tax return, except for a tax shelter or any position without a reasonable basis. So if you don't meet any of those reasonable basis criteria, then you can still be penalized. Or if it has to do with a tax shelter, you can still be penalized. The next type of substantial understatement is a substantial understatement due to willful or reckless conduct. So a tax preparer makes a willful attempt to understate tax liability, or an understatement is due to reckless or intentional disregard of rules or regulations. The penalty here is the greater of $5,000 or 75% of the income the preparer received or would have received for preparing the tax return. So the difference between the willful or reckless understatement and the understatement we talked about before is that the one we talked about before could just be that you're bad at your job. The willful or reckless one is not just because you're bad at your job. It is something you are doing intentionally. And so that is the difference. Other preparer penalties. So we're going to run through a list of these, and you're going to see a lot of them are the same. So it's fairly easy to memorize. And you can see for each of these, we've got 2 lines. So for example, this first one is failure to furnish a copy of a tax return to the client. So when you prepare a tax return for the client, you need to give them a copy. It can be an electronic copy, but you need to give them a copy. If you do not, for any return that was filed in 2026, so for the exam, we're dealing with the 2025 tax year. Most of those tax returns are going to be filed in 2026. So for any tax return filed in 2026, if you fail to furnish a copy to the taxpayer, then it is $65 per return, up to a maximum of $32,500 per year. So maybe you've got thousands of clients and you didn't give a copy of the return to any of them. It's $65 each, up to a maximum of $32,500. If the return was filed in 2025, then it's $60 per return, up to $31,500 per year. Again, most of the time on the exam, they're going to be dealing with a 2025 tax return, which would be filed in 2026. But I wanted to give you both of these just in case. Same exact fines for failure to sign a return that you're supposed to sign, for failure to furnish a PTIN on a return, or for failure to retain a copy of the return for yourself, or a list of the returns prepared. So if the IRS ever comes to you and says, I want to see a list of all the returns that you prepared for this year, you need to be able to provide that to them. If you cannot, then you have that fine, $65 per return, up to that maximum $32,500. Failure to file a correct information return. So it's a 1099 W-2, for example. Same fine, $65 per return, up to $32,500 per year. Then we get to endorsing or negotiating a client's refund check. Are you ever supposed to do that? No, but if you do, if it was filed in 2026, $650 per check. 2025, $635 per check. And then failure to exercise due diligence with any of those 8867 items, the earned income credit, child tax credit, etc., $650 per failure for those filed in 2026. Promoting abusive tax shelters. So if you give a false statement about the tax benefits of a tax shelter, then the penalty is 50% of the gross income made from the activity. If you provide a gross valuation overstatement, so a lot of times these things have to do with depreciation or depletion, etc., and that has to do with the value of the underlying property. So if you give a gross valuation overstatement in order to inflate those deductions, then the penalty is the lesser of $1,000 or 100% of the fee received for that engagement. For a disclosure or use of tax information without the client's consent, remember we've got that confidentiality. Well, if you violate that, you could have both civil and criminal penalties. Civilly, it's $250 per disclosure, up to $10,000 per year. If it involves identity theft, then it goes up to $1,000 per disclosure, up to $50,000 per year. Unfortunately, there have been tax preparers involved in identity theft, either stealing the information themselves and using it or selling the information to others. So they make the penalties more harsh in order to really discourage that. Then there can also be these criminal penalties, which is a fine of up to $1,000 and or 1 year in prison, and that can be up to $100,000 if it is in connection with identity theft. And then aiding or abetting the understatement of a tax liability is $1,000 or $10,000 if it is a corporate return. And then you should also know for the exam that fraudulent returns can be filed either with the cooperation of the client or without their knowledge. So, for example, a preparer could give a copy of a tax return to a client, and then after the client leaves, the preparer could add bogus deductions and credits, and they could change the account information to redirect the refund to the preparer. Well, in that case, obviously, the client had nothing to do with it. As far as they knew, when they left, they had a valid tax return that was done, but the preparer committed fraud without their knowledge. Now, of course, they could do it with their knowledge as well. They could go in and they can make up all the deductions and credits, etc., and then maybe they split the refund or something. Then they both are committing fraud at that point. And preparer fraud may benefit the practitioner directly, such as by stealing a portion of the refunds, or indirectly, such as by charging higher fees or obtaining new clients. So maybe this practitioner is getting their clients these huge refunds by making all these things up. They're not taking any of that money, but they're getting a lot of referrals because word gets around, hey, if you go to this preparer, they'll get you a big refund. So because of that, they get a lot of new clients. So that is also a way they benefited from the fraud. And then in addition to civil penalties, anytime you've got fraud, the IRS Criminal Investigation Division is also going to be involved, and that's when people are going to go to prison. Those who are found guilty of felony tax fraud or false statements are subject to a fine of $100,000 or $500,000 if it's a corporation, and up to 3 years in prison. Those who are found guilty of filing a fraudulent return or other document are subject to a fine of $10,000 or $50,000 if a corporation, and up to 1 year in prison. And of course, people can be guilty of both of these things at the same time, and they can be guilty of multiple counts of both of these things, which they frequently are, in which case then they've got even more jail time and more penalties. And that is the end of video 1 of part 3 covering practices and procedures. Remember, study the slides along with Circular 230 and Publication 947. In our next video, we will go into detail about representation before the IRS. So I will see you in video 2.